Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Brian Joyce. He's a managing director on Nasdaq's Market Intelligence Desk. Brian, great to have you with me. As always, you would think Tuesday never happened looking at the market action today.
Yes, today we're up across the board. A lot of green, not just here in the U.S., but overseas, especially in Europe also. The DAX is higher. The French index is higher. Here in the U.S., the S&P 500 is now within 1.5% of its all-time high. So August and yesterday's redness, seems like a long time ago.
And I can't find anything where the headlines have changed that much. The only thing I could think of is you're not getting yield anywhere else, so everyone's keeping their money in U.S. equity markets?
Yeah, well, we had a lot of bearish sentiment, and obviously because of last month, what happened, equities last month didn't really actually pull back all that much on a broad basis. The S&P 500 was down 6.5%, and that move was complete by the first week of August, and then it was range bound between 28.20 and 29.40 on the upside. But the bond market is really what had everyone concerned. You had the 10-year and the 30-year Treasury yield had the biggest monthly declines, the second biggest monthly declines since 2008, since December 2008. So pretty historic moves last month.
All right, let's take a look at bonds, by the way. We can pull up our first chart here. This is a dollar amount of negative yielding bonds. I mean, that's just a stick straight up.
Right, so this just reflects the extreme bearish risk-off move we saw in August, and this is as of the end of August, and as you can see, it finished just below 17 trillion. It was a 21% increase in the amount of global negative yielding debt, so it's truly a phenomenal move. Investors looking at this point, looking for a return of their capital, not a return on their capital.
All right, moving along to our next chart, we're going to take a look at gold spot here. This has really been quite the conversation here, gold and what's happening in the metals. What are you taking a look at here?
Yeah, so this is the chart, the monthly chart of gold. So it's a very long-term trend. You can see it peaked in 2011 and then has been in a 5-year decline, which bottomed in 2016. And then we had a multi-year, let's say a 5-year kind of sideways trading in about a 350-point range between 1050 on the downside and roughly 1375, 1400 on the upside. So we did have a breakout above that 5-year resistance in June. It was an 8% move in the month of June. In July, we kind of had a break, and then this past month in August, it resumed the upside. And what's interesting about this is the dollar has been moving stronger as well. And typically, most people view the dollar and gold as being inversely correlated, and that hasn't been the case here. So gold is not just necessarily a hedge against inflation, but it's also a hedge against uncertainty. And then the fact that you have all that negative yielding debt, it's a good store of capital.
All right, let's move along to our next chart. The gold-silver ratio, that suggests that silver might outperform at this point.
Yeah, so at this point, what we see here, it may be tough to see with the color of the lines, but it did break out above that 40-week moving average in this past month. What was interesting is that, when gold does well, silver usually trails along and usually outperforms or underperforms. In an up market, silver will tend to outperform gold. And in a down market, silver would tend to underperform gold. So it has a higher beta characteristic, so to speak. Coming into July, silver was actually negative year to date. And it was really in July when silver made its bullish breakout in mid-month, which we'll see in the next chart. But this is the ratio chart. It reflects that the multi-year trend of silver underperforming gold looks like it may have just changed in the last month or so.
All right, now if we take a look at our last chart here, the weekly on silver suggests something else. If you look at a longer-term picture, it might be coming in a bit, and a top may have been made. And we're seeing that certainly in the action today with gold and silver.
Yeah, so this week it's a little concerning. It looks a little toppy. Just to go back a little bit, the breakout that I was referring to earlier is highlighted there by the white arrow. In mid-July, it went from negative on the year to positive, had a bullish breakout above the multi-year declining trend line. Yesterday, it was making its year-to-date high, which is certainly constructive and bullish. It's up currently right now about 21% year-to-date. Gold is up 18%. So the move this month and last month has now silver outperforming gold when it came into July, being down on the year, and gold is up at least 15%. But this candlestick, it reflects, it's a weekly candlestick, but it's well off the highs from the week, which just began yesterday. But that's a very toppy looking candlestick pattern right there. You see the wick that shows the intraday or the intra-week high, a high range. It's pulled back quite a bit from that. So today's finish and tomorrow's close will be kind of key in determining whether or not this finishes out the week as a topping candlestick, which in the short to intermediate term would mean just a period of corrective price action may be underway, which would not be a bad thing given the dramatic move we have already seen. But the longer term monthly period chart that we just saw in gold, silver is kind of similar, would make me feel that pullbacks will likely be bought.
All right, to wrap up here, let's talk about the broader market overall. September seasonally is a weaker month. You wouldn't think that was the case, Thursday and Wednesday. Do you think we'll continue to see that range-bound action that we saw in August and leading up into today?
It's hard to say. It is, as you said, a typically volatile month. What has me most concerned is the strength in the dollar. Now we certainly could see the dollar and equities rise for a period of time, and that could certainly extend into 2020. But the increasing value of the dollar, it's a drag on liquidity globally. So we'll see how that impacts the markets and equities going forward. I still don't think we're out of the woods yet in the short term. We break out to new highs in the S&P 500. That certainly may change things. I am very pleased to see today's breakout over the recent range of the last 4 or 5 weeks. But again, I would not be surprised if in the very short term we do see some volatility.
Well, of course, too, we're also in an earnings vacuum until the second and third week of October, so traders are going to be laser focused on what's happening with the Fed and other global central banks, of course, U.S. and China. So I feel like those 4 or 5 weeks when there is no corporate data out there and you're just focusing on macro and less liquidity, that can lend for some choppy action.
Absolutely. And next Thursday we have the ECB, and you're seeing a growing chant for them to not cut rates any further into negative territory because it's just decimating the banking system. And the following Wednesday we have our FOMC. The expectation is a 25 bip rate cut. So we'll see how that all plays out. But I think the ECB will be pretty important to see on how they handle their situation.
All right, well, we'll certainly talk about that next week. Thanks so much, Brian, as always, for joining me. And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.